If you've ever bought something because it felt like the whole world had already decided it was going up, and then it dropped so fast you couldn't even explain what you owned, I want you to hold that feeling for a second, not the number on the screen, the feeling, because that feeling is what makes ordinary investors lose money fast, not because they're dumb, not because they're lazy, but because modern markets are engineered to turn your attention into a lever and your emotions into a trigger. Picture a normal Sunday night. You're not a hedge fund. You're not Wall Street. You're a real person with a 401k, maybe a Roth IRA, some savings, a mortgage or rent, groceries that cost more than they used to, and that quiet pressure in the back of your mind that whispers, I can't fall behind. You open your phone. Your feed is a parade of certainty. Someone is yelling about an AI stock that's changing everything. Someone else is posting screenshots of options gains like it's a video game. A third person is telling you a stock is on sale, down 70%, and this is where the smart money buys. And right there, right in that moment, you're standing in front of a door. On one side of the door is what Benjamin Graham called investment, a disciplined purchase based on evidence, value, and a margin of safety. On the other side is speculation, a purchase based on excitement, urgency, and hope that someone will pay you more. Most people don't intend to speculate. They just drift into it, one click at a time. So in this video, I'm going to walk you through the 3 hype traps that make ordinary investors lose money fast, not in theory, in the exact ways they show up in your life, your retirement timeline, your stress level, your decision making. And for each trap, I'll give you a Graham-style filter you can use before you hit buy. Simple enough to remember, serious enough to protect you. Because here's the twist: most people never learn until they've already paid for it. The market doesn't take money from people who don't know the news. It takes money from people who can't control themselves when the news hits. This is Benjamin Graham Investing. Let's get you hype-proof. And just quickly, this is educational, not personal financial advice, but it might be the most practical, protective education you hear all week. Now let me introduce you to a character Graham made famous, Mr. Market. Mr. Market is not the market as a spreadsheet. He's the market as a moody business partner. Some days, Mr. Market shows up euphoric. He offers you absurdly high prices because everyone is confident, everyone is chasing, and nobody wants to be the only person not invited to the party. Other days, he's depressed. He offers you absurdly low prices because everyone is scared, everyone is dumping, and nobody wants to be the last person holding the bag. Your job is not to match his mood. Your job is to use his mood. But hype does something dangerous. It makes you treat Mr. Market like a prophet instead of a salesman, and that leads to trap number 1. The first hype trap is the one that feels the most intelligent in the moment. It's the story stock trap. This is where you buy a business because the story is so clean, so modern, so inevitable that your brain stops asking the boring question. You know the story because you've heard it 1,000 times. This company is disrupting a giant market. They're not profitable yet, but they're growing users. Traditional valuation doesn't apply. They're reinvesting. It's early. This is the next Amazon. Today the story might be AI, or robotics, or cloud, or biotech, or the next revolution in energy, or a platform, or a network effect, or whatever new label makes the old human instinct feel like a smart new strategy. And listen, stories aren't worthless. Innovation is real. New industries do create real wealth. Graham understood growth, but he also understood something sharper. The stock market will happily let you pay tomorrow's success price today, plus a premium, plus an excitement tax. That excitement tax is where ordinary investors get crushed, because the story stock trap isn't just you bought a company with no profits. It's deeper than that. It's when the story replaces the business. It's when your confidence is based on narrative, not numbers. And the market loves that because narrative is elastic. You can stretch it, twist it, and keep believing even as reality breaks underneath it. Here's what happens in real life. A company has a great story. The stock runs. Financial media repeats the story. Social media amplifies it. Analysts raise targets. People start saying, this is a long-term hold, even if they bought it last Tuesday. Then the company reports earnings. Not even bad earnings, just not perfect. Maybe revenue growth slows from insane to very good. Maybe guidance is cautious. Maybe margins compress. Maybe customer acquisition costs rise. Maybe interest rates stay higher longer, and the future becomes less valuable in the present. And suddenly, the stock drops 20% in a day. You tell yourself, it's fine, long term. Then it drops another 20%, then it drops again. Now you're not investing anymore. You're defending yourself. And here's the quiet killer most people don't see coming: dilution. The story company often funds itself by issuing more shares, or paying employees with stock-based compensation, or raising capital at the top because the valuation is high, then needing more capital when the valuation is lower, which means issuing even more shares. Your slice of the pie shrinks while you're staring at the pie chart. Graham would ask one question that cuts through the fog like a knife. What is the business worth as a business? Not what the ticker is worth as a trend. Not what people hope it becomes. Not what the total addressable market could be in a perfect world. Is it worth based on demonstrated earning power and a conservatively reasoned future? And if you're thinking, okay, but how do I apply that without becoming an accountant? Here's your first Graham-style filter. I want you to remember it, a seatbelt. Before you buy any story stock, ask, if the story disappeared tomorrow, would the numbers still make sense? That's it. And to make it concrete, here are 3 quick tests you can run in minutes. No fancy models, no spreadsheet worship. First, where are the earnings? Not adjusted earnings. Add back everything unpleasant like it's optional. I mean real earnings power. Profits that can exist without heroic assumptions. If the business has no proven ability to convert sales into durable profits, you're not buying an investment. You're buying a promise. Second, how strong is the balance sheet? Graham was obsessed with financial strength because he lived through markets that didn't forgive weakness. Check cash, debt, and whether the company can survive a recession, a credit squeeze, or a risk-off year. If rates stay high, debt gets expensive. If the economy slows, weak balance sheets don't get a second chance. Third, what did you pay relative to reality? You don't need a perfect intrinsic value number. Graham didn't worship precision. He worshiped protection. You need a range, a conservative estimate, and then a margin of safety. If the stock price requires everything to go right for 5 straight years, you don't have a margin of safety. You have a prayer. And here's the psychological trap inside this trap. Story stocks make you feel like you're early. But being early in the market often looks identical to being wrong. So the antidote isn't cynicism. The antidote is discipline. Graham didn't say, never buy growth. He said, separate what you know from what you imagine and pay a price that protects you if you're wrong. Now, if you've fallen for the story trap before, Don't beat yourself up. Mr. Market is an expert salesman. He will walk into your house and show you a projection instead of a balance sheet because he knows which one makes you feel something. But the next trap is even more dangerous because it doesn't just make you overpay, it makes you fragile. Trap number 2 is the easy money trap. This is where you don't just buy the hype, you amplify it with leverage, option, margin, leveraged, ETFS, just a little, borrowing, short-term trading, chasing high yield like it's free money, anything that turns a normal market swing into a personal emergency. And this trap is everywhere right now because it's addictive. It offers the fantasy that you can compress time, that you can skip the boring part, that you can catch up in a month what normally takes years. And that fantasy is lethal to retirement plans because retirement isn't built on your best week. It's built on your ability to stay in the game for decades. Graham's defensive investor approach is basically this. You don't need to be brilliant. You need to be unbreakable. Leverage makes you breakable. Here's how it usually starts. You see someone post an options win, a 10x, a screenshot, a victory lap. You think, I'm not going to gamble. I'm just going to take a small position. And that's how it gets you, because it rarely feels like gambling at the beginning. It feels like being proactive. But options don't just magnify gains. They magnify timing risk. They add an expiration date to your thesis. With a solid business bought at a good price, time can be your friend. With leverage, time becomes your enemy. Now add the modern market environment, volatility spikes, headlines whipsaw, Fed decisions, inflation prints, recession chatter, AI hype cycles, geopolitical shocks. A perfectly normal drawdown becomes a forced decision. Margin calls don't care about your conviction. Options don't care that you were right eventually. Leveraged products don't care that you had a plan. They care about one thing, price movement on their schedule, not yours. And that's why ordinary investors lose money fast here. Not because they're always wrong, but because leverage punishes you for being early, for being late, for being human. Graham's lens is brutally clarifying. He would separate investment from speculation, not as a moral judgment, but as a risk management boundary. If you want a practical Graham rule you can apply starting today, here it is. Never fund your long-term future with a short-term weapon. That means your 401k, your IRA, your core brokerage plan, your wealth foundation should not depend on leverage, speed, or constant decisions, because the most expensive fee in investing isn't a management fee. It's the fee of panic. It's the hidden cost of being shaken out at the bottom, then buying back at the top. So what's the antidote? It's not be fearful. It's build a structure that makes fear irrelevant. This is where Graham becomes almost comforting, because his defensive investor blueprint doesn't require you to predict the market. It requires you to design a portfolio and a process that can tolerate the market. Start with the boring edge. Cash isn't a failed investment. Cash is optionality. Cash is the ability to not be forced. Short-term treasuries, T-bills, high-yield savings, those are not giving up. Those are shock absorbers, especially when yields are meaningful. High-quality bonds are not exciting. They are stabilizers. Low-cost index funds and diversified ETFs aren't glamorous. They are durable. And asset allocation isn't a buzzword. It's your emotional thermostat. When you hold a sensible mix, stocks for growth, bonds and cash for stability, you reduce the chance that one ugly year becomes a life-altering mistake. Then comes the single most underrated action in personal finance: rebalancing. Rebalancing is basically you doing the opposite of hype on purpose. When stocks run hot and your allocation drifts, you trim and restore balance. When stocks crash and you're terrified, you add and restore balance. It feels wrong. That's why it works. And notice what this does. It turns Mr. Market's mood swings into a mechanism that benefits you instead of controls you. Now, I can already hear someone saying, yeah, but what if I want to take some shots? What if I want some upside? Fine. Graham wasn't naive. People speculate. The key is containment. If you absolutely must, create a separate small speculation bucket. Money you can afford to lose without touching your retirement timeline or your sleep. 5%, 10% for some people. But the point is, it's capped. Your future is not collateral for your excitement, because the easy money trap doesn't just steal money, it steals time. And in investing, time is the one asset you can't replace. Now, here's the part that catches even disciplined people, because trap number 3 shows up wearing the costume of value investing. It sounds like prudence. It feels like patience. It even uses the language of Benjamin Graham. But it is not Graham. Trap number 3 is the "it's on sale" trap. This is where you see a stock down 50%, 70%, 80%, and your brain concludes it must be cheap. Because in normal life, when something is down 70%, it's a bargain. But stocks are not sweaters. Sometimes a stock is down 70% because it was overpriced. Sometimes it's down 70% because the business is deteriorating. Sometimes it's down 70% because the balance sheet is weak and survival is uncertain. And sometimes it's down 70% because the market is correctly repricing a dream into a reality. This trap is brutal because it gives you a false sense of intelligence. You start thinking, I'm contrarian. I'm doing what others won't do. I'm buying fear. And sometimes that's true. But sometimes you're not buying fear. You're buying a leak in the boat because the boat is cheaper than it used to be. Here's how the on-sale trap talks to you. It can't go much lower. The PE is low. The dividend yield is huge. Wall Street is wrong. It's a turnaround. It's a deep value play. And then you buy. And maybe it bounces. Sometimes it does. Markets are messy. But then the next earnings report hits, or the next recession scare, or the next debt refinance, or the next margin squeeze, and the cheap stock drops again. And now you're trapped. Because psychologically, a falling stock feels like a test of loyalty. You start averaging down because it feels like conviction. But what you're often doing is anchoring. You're anchored to the old price. You're anchored to the idea that down equals cheap. Graham's most important distinction, may be the one that saves more people than anything, is the difference between price and value. Price is what you pay. Value is what you get. And the gap between them, when you insist on a meaningful gap, is your margin of safety. A margin of safety is not a slogan. It's the entire philosophy. It's how you survive being wrong. Because you will be wrong sometimes. Everybody is. The goal is not perfection. The goal is resilience. So how do you avoid the on-sale trap without missing real opportunities? You apply Graham's quality and financial strength screens. Not because you need to be fancy, because weak companies don't give you time. They force you into decisions. Here are the fastest danger signs that separate a value opportunity from a value trap. First, the balance sheet is deteriorating while the story is turnaround. If debt is high, refinancing is uncertain, or cash is bleeding, you don't have a bargain. You have a countdown clock. In a world where interest rates can stay higher, balance sheet strength matters more than social media conviction. Second, the cheap valuation depends on peak earnings. A low PE can be a mirage if earnings are temporarily inflated. Cyclical businesses look cheapest right before profits fall. That's not a market conspiracy. That's math. Third, the dividend yield looks too good. Sometimes a high yield is the market screaming that the dividend is not safe. People buy for income and then get hit twice. The price falls and the dividend gets cut. Fourth, the business is losing its competitive position. Graham cared about stability for a reason. If margins are shrinking for structural reasons, technology shifts, competition, customer behavior, then yesterday's normal may never return. Now, you might be thinking, okay, so what does a Graham-style real cheap look like? It's not down a lot. It's not everyone hates it. It's not cheap relative to last year. It's cheap relative to a conservatively estimated intrinsic value, supported by a business that can endure stress. It's a company with financial strength, asset, liquidity, manageable debt. It's a company with demonstrated earning power, profits that can be reasonably normalized. It's a price that gives you room to be wrong. Graham sometimes bought what people today would call boring, sometimes unfashionable, sometimes ignored, but his boredom was a weapon because the market pays a premium for excitement and often underprices plain, durable earning power. And that brings us to the most important emotional point of this entire video. The on-sale trap is the one that breaks people because it makes them feel rational while they're actually just reacting. You're reacting to the chart. You're reacting to the memory of a higher price. You're reacting to the pain of missing out or the hope of a rebound. Mr. Market loves this trap because it turns your desire to be disciplined into a reason to double down. So the antidote is a simple sentence you can say out loud. Down is not a valuation method. If you can't justify the purchase with conservative business value reasoning, if you can't explain why the business is worth more than the price with a margin of safety, then you're not investing. You're guessing with extra steps. Now let's bring this full circle. Remember that Sunday night person on their phone? Let's go back there. Same room, same quiet pressure, same feed. But this time, instead of Mr. Market pulling you by the collar, you pause, you breathe, and you run a checklist, not a 40-point spreadsheet, not a complicated model, a hype immunity checklist. Here it is. I want you to steal this and use it every time the market gets loud. Question 1. Is this mostly a story? If the bull case is primarily narrative, disruption, TAM, revolution, new era, then you slow down and demand evidence. Where are the real earnings or the path to real earnings without fantasy assumptions? What does the balance sheet look like? How much dilution is happening? Are you paying a price that assumes perfection? If the story disappeared tomorrow, would the numbers still make sense? Question 2. Does this require speed or leverage to work? If the strategy needs options timing, margin, high-frequency decisions, or constant vigilance, it does not belong in your core long-term plan. Graham's defensive investor doesn't build wealth with adrenaline. He builds it with staying power. If you want to speculate, contain it, cap it, separate it from retirement, protect the base. Question 3. Does on sale mean cheap or broken? If it's down a lot, you don't assume bargain. You investigate. Is the balance sheet strong? Are earnings normalizable? Is the dividend actually safe? Is the business still competitively durable? Is there a clear margin of safety between price and conservatively estimated value? Down is not a valuation method. Now, if you do those three things, something almost magical happens. The market doesn't get quieter. Your mind gets quieter. You stop needing the next hot tip. You stop needing to be first. You stop needing to be right this week. You start needing to be safe over decades. And that is the shift that separates people who build wealth from people who donate to hype cycles. Because the truth is, the market will always have a new costume for the same old trap. Meme stocks, story stocks, AI stocks, new paradigm stocks, crypto hype, options mania, leveraged ETFs influencer portfolios, get rich quick cycles dressed up as financial freedom. The labels change. Mr. Market doesn't, and Benjamin Graham's core advice doesn't. He would tell you, make your decisions when you're calm. Build your portfolio so you don't have to be a hero. Demand a margin of safety. Treat speculation as speculation, and never confuse activity with intelligence. If you're a middle-class investor trying to retire with dignity, this is not about beating Wall Street. It's about not beating yourself. It's about building an investment process that survives your worst day. So the next time you feel that itch, the urgency, the fear of missing out, the pressure to do something, I want you to remember this. Hype is not information. Hype is a test. And you don't pass that test by being faster. You pass it by being steadier. One last image before we end. Mr. Market knocks on your door tomorrow morning. He's loud, he's confident, he's offering you a deal. You don't argue with him, you don't insult him, you don't try to outsmart him. You simply ask for the numbers, you demand a margin of safety, and if he can't provide it, you let him leave, because you're not here to be entertained. You're here to be free. And freedom in investing isn't the thrill of a winning trade. It's the quiet power of a plan that can't be shaken. If you want more videos in this channel's style, defensive investor thinking, intrinsic value made simple, Mr. Market discipline, and crash proofing with margin of safety, make sure you're subscribed to Benjamin Graham Investing. And if you do one thing after this video, do this. Write those 3 questions down. Put them where you can see them. Story, leverage, on sale. 3 traps, 1 checklist, and a lifetime of fewer expensive mistakes.